First off, investors, Merry Christmas and happy belated Hanukkah and any other holiday you might be celebrating this time of the year. And on a second note, I want to thank our viewers who wish me well in my recovery on my eye surgery. Don't have the eye patch this weekend. That doesn't mean I've fully recovered. My doctor just said, don't wear the eye patch, so I'm doing what he said. Okay, so on to our content. Frequent Oak Harvest investment content. Consumers know I love data and I love to study the history of stock markets and economic cycles. Why? Because it's largely a real-time view into behavioral finance and investor emotions. The 2024 market outlooks by strategists are out across the media outlets, and most of them read quite opposite the negative herd that entered 2023. Many entered 2023 calling for recessions and/or lower stock markets. From what I've seen, most strategists this year who missed the big rally in 2023 are now out talking much higher targets on the S&P 500. At least 5,000 on the S&P 500 and some in the mid 5,000s already. The investment team at Oak Harvest did not forecast a bad 2023 way back in December of 2022. Many well-known financial personalities called for investors to gorge on stocks at 3,000 or called for months, at least a retest of the October 2022 lows at around 3,500, 3,600 on the S&P 500. But stocks rallied into the first quarter of 2023. Of course, looking back, none of these events to the downside happened. No 3,000, no retest, no October 1987 crash replay. Investors, our second half outlook for 2023 had a year-end target of about 4,730 to 4,800, near all-time highs. Pretty much where we stand right now. Not only that, we called for a summer sell-off in advance of the downdraft and also called the near exact timing for the October lows as well. Our second half 2023 outlook was released back in July and called for a down then up. You can find the link to the outlook in the description below. In fact, I got to pat ourselves on the back here at Oak Harvest. Troy, Charles, and I did a YouTube live stream on Thursday, October 26th, right in front of the seasonal upturn in the fourth quarter. We talked about it in advance. Here's the link in the description below. Many market strategists who are absent or very late to the 2023 rally in stocks are now citing the presidential election cycle, year 4, as a big reason for their now bullish positions and much higher S&P 500 targets. So investors, I'm here to curb your enthusiasm for stocks here into year end, nearing all-time highs of 4,730 to 4,800. If your strategist is only now discussing the presidential election cycle as a positive factor for stocks. Today's episode is titled First Half 2024 Outlook, Part 3, Presidential Election Cycles Year 4, The Grinch That Stole Christmas. Investors, the presidential election cycle has been a real thing in the markets for the decades. It's been a consistent winning strategy time and time again, regardless of which political party is in control of the White House. Here's the data summary compiled by the quant team at Bank of America, Merrill Lynch, and Steve Sutmeyer's group. The data is the data, and yes, it does seem positive for 2024 based on the presidential election cycle. However, many strategists now touting it failed to weigh this strategy in October of 2022 when we first entered the sweet spot of the cycle. And in my opinion, they're now weighing it way too heavily for 2024, just to back up their forecasts, as they seem to be trying to play catch up to the markets. Let's look at the monthly data for year 3, historically the most bullish for presidential cycles. Investors, I only know a couple of strategists who strongly messaged this factor or pattern in late 2022 when the markets were on their lows as positive for stocks in 2023. And of those who did, I know even fewer who also messaged a summer pullback in October of 2023 would create a big buy for the fourth quarter rally. For what it's worth, Oak Harvest was one of these firms. Unfortunately, while I do believe this will be a somewhat helpful factor for 2024, I don't share the others' enthusiasm for how much the normal monthly pattern for the year of 4 will hold in 2024. Furthermore, as we exit 2023 near all-time highs, I can't find this factor helping the markets exceed S&P 500 5,000 in the first half of the year. Hence, first half 2024, owed to REM, S&P 500 greater than 5,000, I can't get there from here. Take a look at the monthly returns for every fourth-year presidential cycle since 1928, along with the average and median returns in the lower table. The average monthly return profile argues for the S&P 500 doing absolutely nothing during the first half of 2024. It equates to about 0.5% up for the first 6 months of 2024. Investors, the median monthly return profile argues for a first half 2024 return of just 4.5%. From the current level, when we're filming this video on Monday, that would equate to about a 5% return at the end of the second quarter of 2024. Unfortunately, when looking at the finer detail of the last 100 years and comparing our current cycle that started in October of 2022 to previous ones, my work continues to say we are currently still mirroring a prior cycle that most investors would rather forget. October 1998 through March of 2000, the internet.com bubble. In late 2023, Jerome Powell is talking quite similarly to Alan Greenspan in late 1999, as both are trying to calm the bank markets for year-end and give the banks better year-end liquidity and balance sheet mark-to-market positions. Should we continue to trade on the top of this pattern? Let's see, in late January or late February of 2024, should the markets fall 7 to 10% rapidly, which happened in early many of these years, how many sell-side strategists step up bullishly? Let's see if volatility doubles to the low to mid-20s, how many of these strategists step up citing presidential election cycles as a reason to buy the dip, buy the pullback or correction for targeting new all-time highs in the late first quarter or second quarter of 2024. Historically, most strategists won't do it. Most of the time, you'll see most of these people cut their targets in a down market and increase them in up markets. As for now, that's not what Oak Harvest is planning on doing on any swift and sharp down move in the markets lower in the first quarter of the year. Investors, for now, our first half outlook for 2024 remains as it has been alluded to for almost a year. The first quarter of 2024 should usher in a year of heightened volatility. This volatility should present itself almost immediately in the first few weeks of the year and throughout the first half of 2024. That's the bad news. The good news, new all-time highs in the S&P 500 are likely coming in the first half, most likely late first quarter. And the S&P 500 can near 5,000. That level is not inconceivable at all, just more of the old normal returning to the equity markets for 2024. However, listeners, investors exceeding and sustaining levels above 5,000 on the cash S&P 500 for the first half of 2024, well, investors, sorry to say, I can't get there from here. This is why our investment team believes that more active and tactical investing and trading strategies versus buy and hold ones will likely be a better way to invest for a couple of years. Stay tuned for more on that topic in the weeks and months ahead. Investors, I want to personally thank you for tuning into this channel over the year. I hope it's been educational. And clients, I want to thank you for trusting in Oak Harvest to help you manage your financial future. From myself, from Troy, Jessica, the whole team here, the whole family at Oak Harvest, have a blessed new year.